Navigating the new normal. Why inflation will stabilize at 3% and the end of the 2% era. Inflation trends over the past decade have displayed significant variability, influenced by various global economic events and domestic fiscal policies. Initially marked by modest rates, inflation saw a sharp increase in recent years due to unprecedented events such as the global pandemic, which disrupted supply chains and altered consumer spending patterns. Inflation refers to the rate at which the general level of prices for goods and services rises, eroding purchasing power. It's a critical economic indicator that affects decisions ranging from monetary policy to individual investments. High inflation can lead to increased cost of living, while deflation can signal weak demand and economic downturns. Comparing inflation rates from the past 20 years reveals insights into economic resilience and vulnerability. The early 2000s experienced relatively low inflation, which spiked during the financial crisis of 2008. Post-crisis recovery was slow, with inflation gradually stabilizing, only to be disrupted again by recent global challenges. The current 3% inflation rate marks a tentative stabilization, reflecting efforts from central banks and governments to manage economic recovery post-pandemic. This rate suggests a balance being sought between fostering economic growth and containing the price level increases that constrain average consumers. Several factors contribute to the stabilization of inflation at 3%. Key among these are adaptive monetary policies, such as adjustments in interest rates by central banks and government stimulus measures. Additionally, improvements in global trade and a gradual normalization of supply chains have helped temper excessive inflationary pressures. Government policies play a crucial role in influencing current inflation rates. Various measures, such as tax adjustments and spending controls, are implemented to manage economic stability. Such policies directly affect the money supply and demand dynamics, thereby moderating price-level changes and curbing excessive inflation. Central banks are pivotal in managing inflation through monetary policy tools like interest rate adjustments and quantitative easing. These institutions aim to maintain price stability, ensuring inflation remains within a target range. Their actions influence lending rates and investment activities, balancing economic growth against the risk of inflation. The alignment between targeted and actual inflation rates is essential for economic predictability and planning. When actual rates deviate significantly from targeted rates, it can lead to uncertainty and hinder financial decision-making both at the corporate and individual levels. Consumer expectations regarding future inflation can create a self-fulfilling prophecy. If consumers anticipate higher prices, they are likely to spend more immediately, further driving up prices. Understanding this psychological component is crucial for policymakers to anticipate and mitigate inflationary spirals. Global economic events, such as oil price shocks or financial crises, can profoundly influence domestic inflation. These events disrupt global supply chains and trade dynamics, leading to fluctuations in import costs which, in turn, affect the prices of goods and services domestically. Technological advancements significantly influence inflation by increasing productivity and reducing costs in various industries. As automation and digital tools become more prevalent, companies can produce goods more efficiently, often leading to lower prices for consumers. However, this can also disrupt traditional job markets, shifting the economic landscape. Wage growth versus inflation is a critical economic indicator reflecting the health of an economy. When wages rise faster than inflation, consumers have more purchasing power, boosting overall economic activity. Conversely, when inflation outpaces wage growth, it can lead to decreased consumer spending and economic stagnation. The relationship between unemployment rates and inflation is often described by the Phillips curve, which suggests an inverse relationship between the two. Typically, lower unemployment rates lead to higher wages and spending, which can drive prices up, resulting in inflation. However, this relationship has shown inconsistencies in recent economic environments. Different industries experience the effects of inflation uniquely. For instance, the technology sector may see less impact due to rapid innovation and cost reductions, while consumer goods industries might struggle with rising costs of raw materials and production. Understanding sector-specific impacts helps businesses and policymakers tailor their strategies. Inflation directly affects consumer behavior and purchasing power. As prices rise, consumers may cut back on spending, seek cheaper alternatives, or delay large purchases. This change in behavior can further influence the economy, potentially leading to a slowdown in economic growth if inflation is not managed effectively. Price elasticity significantly influences inflation rates by determining how sensitive the price of a good or service is to changes in demand or supply. Essentially, in markets where goods are considered necessities with few substitutes, prices tend to remain more stable, indirectly moderating inflationary pressures. Inflation forecasting tools and models are crucial for economic planning and decision-making. By analyzing past trends and current economic conditions, economists are able to predict future inflation rates. These forecasts help governments and businesses make informed fiscal and strategic decisions, aiming to stabilize or stimulate the economy as needed. The effect of inflation on savings and investment strategies is profound. Higher inflation tends to erode the real value of money, prompting investors to seek assets that offer returns above the inflation rate. This shift can lead to changes in asset allocation, with a preference for stocks over bonds. Inflation's impact on retirement planning cannot be overstated. As the cost of living increases, the purchasing power of fixed-income retirees diminishes. This necessitates larger retirement savings or investment in inflation-protected securities to ensure that retirees can maintain their standard of living. Comparing the U.S. inflation rate with other countries provides valuable insights into relative economic health and monetary policy effectiveness. Countries with stable inflation rates are often seen as having more effective economic policies, which can attract more foreign investments and promote stronger economic growth. We hope you liked the video. If so, it would help us a lot if you left us a comment, since the YouTube neural network values this very much, and thus recommends our videos to more people. Give it a like and activate the bell so that you receive a notification when we upload our next video. The influence of commodity prices on inflation is significant, as commodities like oil, natural gas, and metals form the base of numerous industries. When commodity prices rise, it leads to higher production costs, which businesses often pass on to consumers in the form of higher prices, thereby fueling inflation. Supply chain disruptions also play a crucial role in affecting prices and inflation. Issues such as delays, shortages, or increased costs in transportation can lead to reduced product availability and higher prices for goods, contributing directly to inflationary pressures in the economy. Inflation measurement is critical for economic policy and planning. It is typically measured by the Consumer Price Index, CPI, which tracks the price change of a basket of goods and services over time. Understanding how inflation is measured helps policymakers and analysts assess the economic health and make informed decisions. Fiscal stimulus, such as government spending or tax cuts, can shape inflation trends by increasing the amount of money available in the economy. While designed to boost economic activity, if not managed carefully, such measures can lead to an overheated economy and rising inflation rates. Short-term and long-term inflationary pressures often have different origins and impacts. Short-term pressures might arise from temporary supply chain disruptions or policy changes, while long-term pressures could stem from demographic shifts or sustained economic growth. Distinguishing between these can help in applying the appropriate monetary and fiscal policies. Inflation not only influences the economic landscape, but also significantly impacts the psychology of consumers and businesses. The rising prices can lead to uncertainty and reduced consumer spending as individuals try to save more against future costs. For businesses, the unpredictability in costs can hinder long-term planning and investment, fostering a cautious approach to expansion and hiring. Countries that have effectively managed inflation offer valuable lessons in economic stability. For example, nations adopting stringent monetary policies and maintaining transparent communication with the public have seen more stable prices. These case studies are crucial for understanding the mix of policies that can curtail sharp rises in inflation and promote economic confidence. Demographic changes, such as aging populations or shifts in workforce participation, also play a crucial role in shaping inflation. Older populations might lead to decreased consumer spending, influencing deflationary pressures, while a booming youth demographic might increase demand for goods and services, potentially driving prices up. Environmental factors, including climate change and natural resource depletion, are increasingly recognized for their impact on inflation. Extreme weather can disrupt agricultural output and supply chains, leading to volatile food prices, while the transition to green energy can initially increase costs, influencing overall price levels across economies. The emergence of digital currencies is creating new dynamics in the inflationary landscape. As these currencies gain acceptance, they could offer alternative economic systems with different inflationary behaviors. The decentralized nature of cryptocurrencies means they aren't tied to traditional fiscal policies, potentially leading to a profound shift in how inflation is understood and managed. In the realm of economics, debates around inflation are frequent and fervent. Economists often find themselves divided on the causes and cures for inflationary pressures. While some advocate for tighter monetary policies to curb inflation, others argue for more expansive fiscal measures to stimulate growth, highlighting how deeply interpretations and recommended strategies can vary among experts. The media plays a crucial role in shaping public perceptions of inflation. By emphasizing certain metrics or economic forecasts, news outlets can influence consumer confidence and market behavior. This coverage can sometimes lead to panic buying or saving, which in turn can exacerbate inflationary trends, showing the power of media narratives in economic cycles. Government budgeting and debt are significantly impacted by inflation rates. Higher inflation can erode the real value of government debt, making it easier to manage in some respects. However, it can also increase the cost of borrowing and disrupt budget forecasts, posing challenges for fiscal stability and policy planning. Businesses facing persistent inflation must adopt strategic approaches to remain viable. Cost management becomes crucial, as companies must decide whether to absorb increased costs or pass them on to consumers, which can affect competitiveness. Additionally, businesses might explore automating processes or securing long-term contracts for supplies to mitigate the effects of rising prices. The performance of the stock market often reflects the prevailing inflationary environment. Inflation can lead to higher interest rates, which typically decrease stock valuations. Conversely, moderate inflation may boost stock prices as companies pass on costs to consumers, driving revenue growth. Therefore, investors closely monitor inflation indicators to adjust their strategies accordingly. Inflation significantly influences the real estate market by affecting property values and rental rates. As inflation rises, so too can the cost of homes, making it difficult for buyers to afford mortgages. Conversely, landlords may increase rents to keep up with rising costs, impacting affordability for renters. Educational costs are not immune to the impacts of inflation. As the general price level increases, so do the costs associated with higher education. This includes tuition, textbooks, and other school-related expenses. Students and families may find it increasingly challenging to budget for education without substantial financial aid or loans. The healthcare sector also grapples with inflation, which can lead to higher costs for medical services and products. This inflation affects everyone from individual consumers to large healthcare providers and insurers, potentially leading to higher premiums and out-of-pocket expenses for patients. Political stability plays a crucial role in controlling inflation. Countries with stable governments tend to implement more consistent economic policies, which can help manage inflationary pressures. Conversely, political turmoil can disrupt economic activities and exacerbate inflation, making it harder to manage. Returning to a 2% inflation target may no longer be feasible in the current economic climate. Various factors, including global supply chain issues and changing labor markets, have shifted economic conditions. These changes suggest that a slightly higher inflation rate might be the new norm for maintaining economic stability.